Hello and welcome to this video where I will explain how different investment vehicles will help you grow your wealth. Investment vehicles are products or accounts that you can use to invest your money and earn positive returns. There are many types of investment vehicles, each with its own risks and rewards. In this video, I will introduce and list the pros and cons of some common investment vehicles. By the end of this video, you will have a better understanding of these investment vehicles and how to choose the ones that suit your goals and risk tolerance. But before we start, make sure you hit the like button, subscribe to my channel, and turn on the notification bell so you don't miss any of my future videos. Alright, let's get started. 1. Stocks. Stocks, also known as shares or equities, are ownership units of a company. When you buy a stock, you become a part owner of the company, and you have the right to vote on important decisions and receive dividends, which are payments made by the company to its shareholders. Stocks are traded on stock exchanges, such as the New York Stock Exchange or the Nasdaq, where buyers and sellers determine the price of each stock based on supply and demand. The main benefit of investing in stocks is that they offer the potential for high returns in the long term. Historically, stocks have outperformed most other investment vehicles over time, as companies grow and increase their profits and value. Stocks also offer liquidity, which means you can easily buy and sell them whenever you want. However, investing in stocks also involves significant risks. Stocks are volatile, which means their prices can fluctuate unpredictably and dramatically due to various factors, such as market conditions, economic news, company performance, or investor sentiment. Stocks can also lose value or become worthless if the company goes bankrupt or performs poorly. Therefore, investing in stocks requires patience, discipline, and diversification, which means spreading your money across different stocks and sectors to reduce your exposure to any single company or industry. 2. Bonds. Bonds are debt instruments issued by governments, corporations, or other entities to raise money. When you buy a bond, you lend your money to the issuer for a fixed period of time and receive a fixed interest rate, also known as the coupon rate, in return. At the end of the period, also known as the maturity date, you get back your principal, which is the amount you initially invested. The main benefit of investing in bonds is that they provide a steady and predictable income stream. Bonds are generally considered safer than stocks, as they have lower volatility and default risk, which means the likelihood of the issuer failing to pay back the interest or principal. Bonds also offer diversification, as they tend to have a negative or low correlation with stocks, which means they move in opposite or different directions. However, investing in bonds also involves some drawbacks. Bonds offer lower returns than stocks in the long term, as they have lower growth potential and are subject to inflation risk, which means the purchasing power of your money decreases over time. Bonds are also subject to interest rate risk, which means their prices fall when interest rates rise, and vice versa. Therefore, investing in bonds requires careful attention to the duration, which measures the sensitivity of a bond's price to interest rate changes, and the credit rating, which measures the creditworthiness of the issuer. 3. Mutual funds. Mutual funds are pooled investments that are managed by professional fund managers. When you buy a mutual fund, you buy a share of a portfolio that consists of various securities, such as stocks, bonds, or other assets. Mutual funds are categorized by their investment objectives, such as growth, income, or balanced, and by their investment styles, such as value, growth, or index. The main benefit of investing in mutual funds is that they offer diversification, convenience, and expertise. Mutual funds allow you to invest in a large number of securities with a small amount of money, reducing your risk and increasing your exposure to different markets and sectors. Mutual funds also save you the time and hassle of researching, selecting, and monitoring individual securities, as the fund managers do that for you. Mutual funds also give you access to the knowledge, skills, and experience of the fund managers, who use various strategies and techniques to achieve the fund's goals. However, investing in mutual funds also involves some costs and limitations. Mutual funds charge fees and expenses, such as management fees, sales charges, or redemption fees, which can reduce your returns and eat into your profits. Mutual funds also have less control and transparency, as you cannot choose the specific securities in the fund or know the exact value of the fund at any given time. Mutual funds are also subject to market risk, which means their performance depends on the performance of the underlying securities and the overall market. 4. ETFs. ETFs, or exchange-traded funds, are similar to mutual funds, but they trade like stocks on stock exchanges. When you buy an ETF, you buy a share of a basket of securities that tracks an index, such as the S&P 500, a sector, such as technology, or a theme, such as ESG. ETFs are categorized by their asset class, such as equity, fixed income, or commodity, and by their strategy, such as passive, active, or smart beta. The main benefit of investing in ETFs is that they offer diversification, low cost, and flexibility. ETFs allow you to invest in a wide range of securities with a single transaction, reducing your risk and increasing your exposure to different markets and sectors. ETFs also have lower fees and expenses than mutual funds, as they have lower management costs, no sales charges, and no minimum investment requirements. ETFs also offer flexibility, as you can buy and sell them anytime during the trading day, unlike mutual funds, which are priced only at the end of the day. However, investing in ETFs also involves some risks and challenges. ETFs are subject to market risk, tracking error, and liquidity risk. Market risk means that the performance of the ETF depends on the performance of the underlying securities and the overall market. Tracking error means that the ETF may not perfectly replicate the performance of the index or the sector that it follows, due to fees, expenses, or other factors. Liquidity risk means that the ETF may not have enough buyers or sellers at a given time, resulting in wide bid-ask spreads or price fluctuations. 5. Real estate. Real estate is a physical property that consists of land and buildings. When you invest in real estate, you can either buy a property directly and use it for your own purposes, rent it out to tenants, or sell it for a profit. Alternatively, you can invest in real estate indirectly through real estate investment trusts, REITs, which are companies that own, operate, or finance income-generating properties, such as office buildings, shopping malls, or hotels. The main benefit of investing in real estate is that it offers income, appreciation, and diversification. Real estate can provide you with a steady and passive income stream from rents, leases, or dividends. Real estate can also appreciate in value over time, as the demand for properties increases or the properties are improved or renovated. Real estate can also diversify your portfolio, as it has a low or moderate correlation with stocks and bonds, and it can hedge against inflation, as the value and income of properties tend to rise with the general price level. However, investing in real estate also involves some challenges and risks. Real estate requires a large amount of capital, as properties are expensive and often require down payments, mortgages, or loans. Real estate also requires a lot of time, effort, and expertise, as properties need to be maintained, managed, and marketed. Real estate is also subject to various risks, such as market risk, liquidity risk, and legal risk. Market risk means that the value and income of properties depend on the supply and demand of the local market, which can be affected by economic, social, or environmental factors. Liquidity risk means that properties are not easy to buy or sell quickly, as they require appraisals, inspections, or negotiations. Legal risk means that properties are subject to laws, regulations, or taxes, which can change or vary depending on the location or the type of property. In this video, I have explained how different investment vehicles will help you grow your wealth. I hope this video has helped you understand these investment vehicles and how to choose the ones that suit your goals and risk tolerance. Remember, investing is not a one-size-fits-all approach, and you should always do your own research, analysis, and due diligence before making any investment decisions. If you like this video, don't forget to hit the like button, subscribe to my channel, and turn on the notification bell so you don't miss any of my future videos. Thank you for watching.